Before we trade a calendar spread, it would be useful to know exactly what a calendar spread is and why it is used. A calendar spread is established by simultaneously entering a long and short position on the same underlying asset, but with two different expiry months. The trade is put on in order to take advantage of changes in the relationship between the two contract months. Generally, traders participating in a calendar spread are concerned with the dynamics of the spread relationship and place very little emphasis on prices in the outright futures market. In most cases, money will be lost in one leg but made in the other. In a successful spread, the gains in one leg will outweigh the losses sustained in the other. In order to put on this trade, the first step is selecting the future we wish to trade. For this example, we will open a position in the BAX, the 3-month Canadian Bankers Acceptance Future, in a calendar spread. To select it, we will first go to the drop-down menu labeled Type and select Futures. Once you do so, a drop-down menu will appear listing the various futures products offered by the Montreal Exchange. Scroll down to the section labeled Interest Rate Derivatives Money Market and select the BAX. In the drop-down menu directly to the right of this, select the Futures Calendar Spreads option and click on Go. In the portfolio screen that pops up below, we will make 4 selections for each leg of the trade: the contract month we wish to trade, the buy or sell this contract, the quantity of contracts to be traded, and the price we wish to pay. The buy, sell, and quantity fields are self-explanatory. However, the other two merit some attention. The BAX trades on a quarterly cycle extending out 3 years, plus 2 nearest non-quarterly months, which are called serials. So we will have 14 contracts to choose from. Other contracts may have different cycles, so ensure that you select the contract that best suits your strategy or market view. Generally, for most futures contracts, most of the liquidity will be in the front month. So if you wish to trade the further contracts, ensure there is sufficient volume to support your trade size. Lastly, we will have to determine which order type you wish to use. A market order, meaning an order that will be executed at the current market price, or a limit order, which is an order that will be executed only at a price at or better than the price you specify. If you select a market order, there's nothing else to do. Your trade will be filled at the prevailing market price. If you select the limit order, you must select the price you are willing to pay in the limit field, and for how long your order is good for in the duration field. In the duration field, we will have 2 options: day and good till cancel. If you select day, the order will be good until the end of the trading day, and will automatically be canceled if it goes unfilled. The good till cancel order will remain valid until it is filled or canceled by the trader. For the purpose of this example, we will open a position by buying 10 of the closest quarterly contract, which is the September 2013 contract, and selling 10 of the next quarterly contract, which is the December 2013 contract, at market. Once we enter the necessary parameters, we click on Preview. The preview screen allows you a last opportunity to change your trade prior to execution. The screen also offers you a glimpse of the cost of your transaction in terms of commission costs and estimated required buying power. The estimated required buying power is the amount of capital that will be tied up in initial margin in order to execute this trade. These same steps can be used to open a position using a limit order or exit the position with either market or limit orders.